All right, let's jump right into this. Welcome back to the Explainer. Now, if you've been following along with our source material, you know we've spent a ton of time unpacking the sheer theory behind crypto markets. We've gone over market mechanics, price action, all those really high-level concepts. But theory only gets you so far, right? You can read literally every textbook out there, but eventually you've got to hit the execution button. So today is the day we make that massive leap from just knowing things abstractly to actual practical execution in your crypto journey. We are going to look at exactly how to build your very first trading strategy. It's time to take the whole shebang you've learned and finally put it to work. We are officially hitting Phase 3, Day 15. And wow, I really want to take a second to acknowledge what a huge milestone this actually is. Think about it. You don't just jump into the markets on day one and expect to crush it. It takes so much patience. You had to build this foundation totally from the ground up. Arriving at day 15 is that critical light bulb moment where all those abstract concepts we've been obsessing over are finally forged into a really tangible action plan. This is where the rubber meets the road, guys. It's where you stop being just an observer and step up as an active participant. So that brings us right to Section 1, the complete rule set. What's really fascinating here is how a successful trading strategy isn't a vibe, it's an architecture. It is absolutely not about guessing, and it's definitely not about trading on a gut feeling just because you saw some coin trending on your timeline. Building a real strategy means having a complete, non-negotiable set of mechanical rules. Let's walk through this chronological blueprint step by step, because you really need to internalize this. Step 1 is your entry. This defines exactly how and when you pull the trigger to get into a trade. Step 2, the stop loss. Arguably the absolute most important piece of the puzzle. Where do you cut your losses if the market turns against you? And trust me, it will turn against you at some point. Step 3 is take profit. At what exact price are you happy to grab your gains and walk away? Step 4 is position size. Based on that stop loss we just talked about, how much of your actual capital are you risking on this one specific trade? And finally, step 5 is the exit, the literal, physical act of closing the trade and getting safely back into cash. The big takeaway? These 5 steps are the life cycle of every single market move. You skip a step, you don't have a strategy anymore, you just have a gamble. Now check out how we can conceptually split this entire mechanical life cycle into 2 totally distinct phases. Over on the left, we've got the front half of the rules, entry and stop loss. This side is all about initiating the trade and, crucially, building a defensive shield right out of the gate. Before you even think about making a dime, you have to think about how much you could lose. Then looking over to the right side, we have the back half, take profit and exit. This is your offense. It's where you secure the bag and finally close the loop on the whole operation. A truly bulletproof strategy perfectly balances that defense on the left with the strict execution of the offense on the right. You've got to have both if you want to survive and thrive out there. All right, let's move right along to Section 2, the setup framework. So you might be wondering, how do we actually take those rigid mechanical rules and apply them to actual fluid market conditions? How do we spot a real opportunity in the wild amidst all the crazy noise? Well, our source material gives us this incredible example framework to do exactly that. We're going to stack 4 essential ingredients, one by one. First up, we need a trend. Which way is the market already moving? You definitely want to swim with the current, not fight it. Second, support. Is there a structural floor holding the price up? You need a logical level to lean against. Third, confirmation. What specific signal proves our idea is actually right? We don't just guess. We sit on our hands and wait for the market to show its cards. And fourth, defined risk. You literally must know what you stand to lose before your mouse even hovers over the buy button. Think of this like being a master architect. You wouldn't build a house without supporting all 4 corners, right? You need every single one of these pillars locked in before you build a trade. When you put the whole thing together, here is your master equation. Trend plus support plus confirmation plus defined risk equals a potential setup. Perfectly balancing those specific variables is what actually gives you the green light to engage. But notice the phrasing here because it's super specific. It doesn't say guaranteed win. It definitely doesn't say free money. It says potential setup. You are essentially hunting for measurable conditions that stack the mathematical odds in your favor using a highly disciplined approach. Honestly, that's all trading really is, just waiting patiently for the math to align over and over again. But hey, that brings up a pretty massive question, doesn't it? You've built this pristine setup. You've followed the rules to the letter. You've got the trend, the support, the confirmation, the risk. Is this a guaranteed formula? I want to just pause right here for a second because we really need a reality check. If you're sitting there thinking you just found a magic money printer, we need to shift gears immediately. Here is the exact, unedited quote straight from the source. Do not treat this as a guaranteed profit formula. I want that sobering warning to completely shatter the illusion that there's some sort of crypto cheat code out there. The market is chaos. It is completely unpredictable on a trade-by-trade basis. What this entire framework gives you isn't a crystal ball. It's a survival mechanism. It gives you structure in a totally unstructured environment. It lets you manage risk and play the long-term probabilities instead of relying on dumb luck. So by all means, take these rules, use this framework, but always, always respect the reality of market risk. That is the real secret to sticking around in this space. So the question I'll leave you with today is this. Do you actually have the discipline to stick to your own rules when the market inevitably tests your patience? Thanks so much for joining me for this explainer, and keep building those strategies.